All right, so in this video, I'm going to talk a little bit about financial leverage and kind of what it accomplishes. So financial leverage can be viewed as sort of the second stage leverage if I'm looking at an income statement, or leverage of the right side of the balance sheet if I'm looking at a horizontal balance sheet. So a horizontal balance sheet would have assets on one side, left side, and then liabilities and owner's equity on the right side. So let's talk about what I mean by second stage leverage on the income statement. So if I start off with sales and then I work my way down to operating income or EBIT, and then I work my way down to net income. Basically, financial leverage is actually going to produce an effect between that EBIT, earnings before interest, taxes, and EBIT, earnings before interest and taxes, and then net income. So it's going to show up basically in that bottom half. The top half, the section between sales and EBIT, that section is going to be affected by operating leverage. So with operating leverage, it's about fixed cost of operation. So think that, the typical fixed cost. So that's the top half or first stage leverage would be the operating leverage. And the second stage would be the financing or financial leverage, which is basically between EBIT and the net income. So basically it happens in the bottom half of the income statement because that's where the interest expense, any preferred dividends, et cetera, they show up basically in that bottom half after the operating income or EBIT on the income statement. Now, when I'm referring to leverage of the right side of the balance sheet, if I do a horizontal balance sheet, I got assets on the left equaling liabilities plus owner's equity on the right. So, kind of like the standard accounting equation, right? Well, so on the right side is the liabilities and owner's equity. And so basically financial leverage is all about what mixture of funding I have over there on that right side of that horizontal balance sheet. So in other words, it's all about basically that, debt, the preferred, and the common, and what mixture I have there. And so the more debt and preferred stock I have, the more financial leverage I've got. And basically what's going to happen with financial leverage is I have some fixed costs that magnify the effects of changes in earnings before interest and taxes on the firm's earnings per share or net income. So here's basically what that would mean. So if my earnings before interest and taxes goes up by 10%, but my interest is not increasing with increases in sales, then that basically would mean that more of that increased operating income or more of that increased earnings before interest and taxes makes its way down to net income on a proportionate basis. So if I increase sales by 10% and operating income goes up by 10%, so EBIT goes up by 10%, but then interest doesn't go up by 10% just because I sold more. So interest is going to stay the same, which means now net income is going to go up by more. And so if net income goes up by more for a given change in that EBIT, I got a bigger percentage change in the earnings per share or the net income. And so basically that's the idea of financial leverage. For a given change in that operating income, I get a bigger percentage change in the earnings per share or the net income due to the financial leverage. But unfortunately, this works both ways. So if operating income goes up, I get a bigger, by say 10%, maybe I get a 20 or 30% increase in net income, perhaps. But that also could work the other direction. So if I get a 10% decline in operating income, I could get a much bigger decline on a percentage basis in net income. So whether leverage is good kind of depends on what sort of year you're having. So if you have a good year, it magnifies good results into much better results. If you have a bad year, it magnifies the bad results into much worse results. So let's kind of think about some connected issues that relate to financial leverage. So leverage buyouts. So the basic idea behind a leverage buyout is an entity borrows a whole bunch of money, financial leverage, to buy out a company. So when they do that and they use all that borrowed money to buy out the company, basically the end result of that is they now have a lot more financial leverage. And if they can make choices that increase that operating income, because of all the financial leverage, I get an even bigger percentage increase in net income or earnings per share. Looks great. We've made the company more profitable. Looks fantastic. If things don't work out, or maybe we go through a recession or things like that, well, that can end kind of badly because I could get a little decline in operating income, but it could lead to almost a collapse of my net income. So, operating income may go down a little, net income could collapse. That could be bad. If you also go back to the material about ratios in prior videos that I've posted, I have a section about DuPont analysis, and basically financial leverage is very much linked to that equity multiplier. So the whole idea behind the equity multiplier was that I basically took this equity multiplier and I multiplied it times my return on assets to get to my return on equity. And basically that equity multiplier was all about looking at the amount of assets over the owner's equity. The more debt or financial leverage the firm has, the smaller the owner's equity will be relative to the assets. The bigger the equity multiplier, the bigger the gap between the return on assets and the return on equity. So if I've got a really large amount of debt relative to my assets, I could have a return on assets of 10%, but I can have a return on equity of, say 50% if my equity multiplier is 5, meaning I've got a lot more assets relative to the owner's equity, which basically means I got a load of debt, right? So it very much links back to DuPont analysis. But another interesting side effect of this with financial leverage is marketing is going to be really important. And the reason for that is small little changes in sales tend to produce those changes in the operating income, which then flow down to and become much larger changes in my earnings per share or net income. So we don't want to have a slide in sales. That's not good. So we need to have lots of good sales, consistent sales, things like that. Marketing starts to matter a lot because small changes in sales get magnified into much bigger impacts on earnings per share or net income there. Which then kind of brings us to kind of a bigger picture point here. And that is if you think about the business cycle. So in other words, looking at kind of how businesses do with the economy and how the economy goes through cycles and recessions and expansions and all that. Something that's kind of important to note then is if a firm has a lot of financial leverage, in other words, a lot of debt, it tends to be much more adversely affected when the economy slides into a recession. So if you get slide into a recession, sales drops a little bit, my operating income drops a little bit, but then because of all that financial leverage, it gets magnified into just potentially horrific scenarios for a company if they have too much debt. So that financial leverage, if the economy is bad or economic cycle kind of takes a downturn, it can lead to really bad outcomes, basically. On the other hand, if you have a lot of financial leverage and you're just coming out of a recession and sales start to go up by, they pop upward by 5%. Well, hey, if they pop upward by 5%, my operating income, let's say it pops up by 5%, all of a sudden that can have a drastically bigger impact potentially, depending on how much leverage is involved. Upon the firm's earnings per share or net income. And so relatively smaller changes in sales could lead to relatively modest changes in operating income, EBIT, which then produces potentially a much bigger pop in the earnings per share or the net income. So ultimately, that's the big picture takeaway for the financial leverage is relatively more modest changes in that operating income or EBIT can produce much larger proportionate changes in the net income for both good or bad. Hopefully this video has been helpful. Thank you so much for watching and have a great day.